What makes a bank fail? Banks are putting your money at risk and you don't even know it. Banks are important in the world as they are a way for you to store your money and also use it for purchases of goods and services like groceries without having to carry cash around. There is a big problem with the banks, though. They are using your money for investments and not telling you. The importance of banks in the economy. Banks play a crucial role in the global economy by providing financial services and facilitating economic activity. They provide a range of services, including lending, deposit taking, and investment management. The health of the banking system is critical to the stability and growth of the economy, and the failure of banks can have significant economic and social consequences. Reasons why banks might fail. Despite the importance of banks in the economy, they are not immune to failure. Here are some of the reasons why banks might fail. 1. Poor risk management. Banks are in the business of taking risks, but when they fail to manage these risks effectively, they can suffer significant losses. Poor risk management can include inadequate underwriting standards, ineffective monitoring of credit risk, or failure to diversify their portfolios. Lately, the Silicon Valley Bank failed because it invested in bonds at a low interest rate and made loans to other companies for business, and the value of those bonds went down, and the businesses didn't do well. This means the bank didn't have enough money to cover all its customers. 2. Economic conditions. The performance of banks is closely tied to the health of the economy. Economic downturns can lead to an increase in defaults on loans, a decrease in the value of assets, and a decline in the demand for credit. These factors can put pressure on banks and make them more vulnerable to failure. 3. Regulatory changes. Changes in regulations can impact the operations of banks and make it more difficult for them to operate profitably. New regulations can increase compliance costs, restrict certain activities, or reduce profitability. 4. Fraud and misconduct. Banks can also fail due to fraud or misconduct. This can include insider trading, embezzlement, or other forms of financial misconduct. Fraud and misconduct can erode investor confidence and lead to reputational damage. The consequences of bank failures. The failure of a bank can have significant consequences for the economy and society as a whole. Here are some of the potential consequences of bank failures. 1. Economic instability. Bank failures can lead to economic instability by disrupting the flow of credit and causing a decline in business activity. This can result in job losses, decreased consumer spending, and a slowdown in economic growth. 2. Loss of deposits. When a bank fails, its customers can lose their deposits. This can cause significant financial hardship for individuals and businesses that rely on these deposits to fund their operations. In some cases, depositors may not be able to recover their funds, leading to further economic hardship. 3. Contagion effect. Bank failures can also have a contagion effect where the failure of one bank leads to a loss of confidence in the entire banking system. This can cause a run on other banks and further exacerbate the economic instability. 4. Government bailouts. In some cases, governments may need to step in and bail out failing banks to prevent a broader economic crisis. This can be expensive for taxpayers and can lead to increased government debt. Conclusion. Banks play a crucial role in the global economy, and their failure can have significant consequences for the economy and society as a whole. Poor risk management, economic conditions, regulatory changes, fraud, and misconduct are all factors that can contribute to bank failures. It is important for banks to manage their risks effectively, adhere to regulations, and operate in an ethical and responsible manner to avoid the negative consequences of failure. Additionally, Governments and regulators must be vigilant in monitoring the health of the banking system and taking appropriate action to prevent and mitigate the effects of bank failures. Banks can do better by only investing in 10% of the entire funds they have on hand, making it far less likely that they won't have enough money for those who wish to withdraw their funds.